Tax-free crypto strategies are searched year-round by every category of crypto investor, beginners, traders, and long-term holders alike, making this topic immune to news cycles and permanently relevant as long as crypto exists. The contrarian angle. Most people overpay crypto taxes simply because they don't know the rules, creates immediate retention, while the actionable legal framework gives viewers a reason to save, share, and return to the video. Strong search intent combined with high perceived value, never pay taxes, ensures durable ranking performance across years. If you've ever sold crypto and felt the stomach drop of realizing you owe taxes on it, this video is going to change the way you think about that forever. What you're about to learn isn't a loophole, it isn't offshore trickery, and it isn't advice from someone trying to sell you something. It's a set of legal strategies that exist inside the tax code right now that most crypto investors have never been told about, and that could legally reduce your crypto tax bill to zero. Most people assume that if you make money in crypto, you owe taxes on it. Full stop. That's the belief that gets repeated in forums, in comment sections, and even by well-meaning accountants who don't specialize in this space. The common assumption is that crypto gains are just income. They're taxable, and the only question is how much you owe. But here's the contrarian truth that changes everything. The tax code was not written to maximize what you pay. It was written with specific carve-outs, specific holding strategies, specific account structures, and specific harvesting techniques that are designed legally to let certain gains pass through without being taxed at all. The proof is sitting in IRS documentation, in court precedent, and in the actual tax returns of sophisticated investors who have been using these strategies for decades in traditional markets and are now applying them directly to digital assets. The plan in this video is to walk you through each of those strategies in plain language, show you exactly how they work, and give you a framework you can take to your own financial situation and start applying immediately. Let's build this from the ground up. The first thing most crypto investors don't understand is that not all gains are taxed equally, and the difference between one type of gain and another can be the difference between owing 37% of your profit to the government and owing exactly zero. The United States tax code and most tax systems globally distinguish between short-term and long-term capital gains. A short-term gain is any profit you make on an asset you held for less than 1 year. That gain is taxed at your ordinary income rate, the same rate applied to your paycheck. And depending on your income bracket, that could be anywhere from 10% to 37%. A long-term gain is any profit on an asset you held for more than 1 year. That gain is taxed at a completely different, much lower rate. And here's the part that most people miss entirely. If your taxable income falls below a certain threshold, your long-term capital gains tax rate is zero, not reduced, not deferred, zero. For a single filer in the United States, as of current tax law, if your total taxable income is below approximately $47,000, you owe nothing on long-term capital gains. For married couples filing jointly, that threshold is roughly $94,000. So the first and most foundational strategy for legally paying no taxes on crypto is simply this. Hold your assets for more than 1 year, manage your total taxable income so it falls within the 0% long-term capital gains bracket, and realize those gains in the right year. This is not exotic. This is the tax code working exactly as written. The practical application looks like this. If you bought Ethereum 2 years ago and it has grown substantially and you're planning to sell it, the question is not just whether to sell, it's when to sell and in what tax year, and whether your other income sources that year put you above or below that bracket threshold. Someone who earns $50,000 from their job in a given year and sells long-term crypto for a $20,000 gain might owe nothing if their deductions bring taxable income below that threshold. That same person, if they sell that same crypto in a year when they also received a bonus that pushed their income higher, might suddenly owe 15% on those same gains. The timing of the sale is a tax strategy. Most people never think about it that way. Now here is where this gets even more powerful, and this is the insight that separates investors who build wealth from investors who constantly feel like they're handing their returns back to the government. The strategy of pairing long-term holding with income management is not limited to people who earn very little. High earners can access the 0% bracket too, just in a different way and through a different set of tools. One of the most powerful is the Roth IRA. A Roth IRA is a retirement account funded with after-tax dollars, meaning you put money in that has already been taxed. But everything that grows inside that account, every trade, every gain, every compounding return, grows tax-free. And when you withdraw it in retirement, you pay zero in taxes on any of it. Zero on the gains, zero on the compounding, zero on the withdrawals. Now, here is why this matters so much for crypto specifically. Crypto is one of the most volatile and highest returning asset classes in history. The same $10,000 that might grow to $12,000 in a traditional bond over several years could, in crypto, grow to $100,000 or more over the same period in a strong cycle. If that 10,000 lives in a taxable brokerage account and grows to 100,000, you owe taxes on $90,000 of gains. If that same 10,000 lives inside a Roth IRA and grows to 100,000, you owe nothing. The Roth IRA does not care how large the gain is. It was never going to tax it. The asset that benefits most from tax-free compounding is the asset with the highest return potential. And for many investors, that's crypto. The way to get crypto into a Roth IRA is through a self-directed Roth IRA, also called a crypto IRA, offered by a growing number of custodians who specialize in holding digital assets inside retirement account structures. This is fully legal, fully recognized by the IRS, and used by a significant and growing number of investors who understand that the account structure they hold an asset in is just as important as the asset itself. The contribution limits for a Roth IRA are relatively modest on an annual basis, but the compounding effect of even modest contributions held in high-returning assets over a decade or more is extraordinary. And because Roth accounts have no required minimum distributions the way traditional IRAs do, the money can sit and compound indefinitely. A less discussed, but equally powerful cousin to the Roth IRA is the Health Savings Account, or HSA. If you have a high-deductible health insurance plan, you're eligible to contribute to an HSA. Most people use HSAs to pay for medical expenses with pre-tax dollars, which is already valuable. But the deeper strategy, one that almost nobody uses, is to invest HSA contributions into assets including, through certain custodians, cryptocurrency, let those assets grow completely tax-free, and then withdraw them for qualified medical expenses with zero tax at any point in the process. Contributions go in pre-tax. Growth is tax-free. Withdrawals for medical expenses are tax-free. It is the only triple tax-advantaged account in the United States tax code. And if you pay for your medical expenses out of pocket rather than drawing from the HSA, you can let the account compound indefinitely and withdraw the original receipted medical expenses at any point in the future, years or even decades later, with no time limit on reimbursement. That means someone who incurs medical expenses today, pays for them out of pocket, saves the receipt, and lets their HSA grow in crypto for 15 years can pull out that reimbursement tax-free regardless of how large the account has grown in the interim. This is a legal strategy that requires nothing more than record keeping and patience. Now let's talk about a strategy that feels counterintuitive, but is one of the most powerful tools in a crypto investor's tax toolkit: tax loss harvesting. The core idea is this: if you hold a crypto asset that has declined in value and you sell it, you realize a loss. That loss can be used to offset gains elsewhere in your portfolio. If your losses exceed your gains in a given year, you can use up to $3,000 of that excess loss to offset ordinary income, and anything beyond that carries forward into future tax years indefinitely. The reason this is so powerful in crypto specifically is the wash sale rule, or more accurately, the current absence of it. In traditional securities markets, if you sell a stock at a loss and then buy the same stock back within 30 days, the IRS disallows the loss under the wash sale rule. You cannot claim the deduction. As of current tax law, the wash sale rule does not apply to cryptocurrency. Crypto is classified as property, not a security, and property is not subject to wash sale restrictions. This means you can sell a crypto asset that has dropped in value, realize the loss for tax purposes, and immediately buy the same asset back. Your economic position in the asset is unchanged. You still own it, but you have crystallized a tax loss that can now offset gains elsewhere, reducing or eliminating your tax liability for the year. This is not tax evasion. This is not aggressive tax avoidance. This is using the existing classification of crypto assets under current law to your mathematical advantage. Sophisticated investors in traditional markets have been harvesting losses this way for decades within the bounds of the wash sale rule. They simply have to wait 30 days before rebuying the same security. Crypto investors currently have no such restriction. A practical example makes this concrete. Suppose you bought a smaller altcoin earlier in the year and it dropped significantly. You also had gains from selling Bitcoin or Ethereum at a profit. If you sell the underperforming altcoin before the end of the tax year, that loss offsets your gain dollar for dollar. If the loss equals the gain, your net taxable gain for the year is zero. You then immediately repurchase the altcoin at its current lower price, resetting your cost basis at a lower level, maintaining your exposure, and effectively paying no taxes on gains you actually realized. There is an important caveat here. Tax law in this area is evolving. There have been legislative discussions about extending wash sale rules to crypto, and this could change. The strategy is legal under current law, but it is worth monitoring, and it is worth working with a tax professional who understands the current state of the law, rather than assuming it will remain static indefinitely. This brings up a broader principle that underpins everything in this video. The tax strategies available to you depend on the classification of the asset, the account structure it lives in, the length of time you've held it, and the composition of your overall income in a given year. None of these variables are fixed. All of them are within your control to some degree. The investor who treats taxes as something that just happens to them after the fact is always going to pay more than the investor who plans around these variables intentionally throughout the year. The next strategy operates at a slightly more sophisticated level, but is increasingly accessible to retail investors: opportunity zone investing and charitable giving structures. If you've held a crypto asset for a long time and it has appreciated dramatically, selling it triggers a large capital gain. But there is a mechanism in the tax code called a qualified opportunity zone, or QOZ investment, that allows you to defer that gain, reduce it over time, and potentially eliminate taxes on any new appreciation entirely. Here is how it works. You sell your appreciated crypto. Instead of paying taxes on the gain immediately, you reinvest the gain, not the full proceeds, just the gain itself, into a qualified opportunity zone fund within 180 days. By doing so, you defer the original gain until a future date, and if you hold the opportunity zone investment for at least 10 years, any appreciation inside the opportunity zone investment is excluded from taxation completely. This is not a fringe strategy. It was created by Congress as part of the 2017 Tax Cuts and Jobs Act specifically to encourage investment in designated economically distressed areas. It has been used by institutional investors and high net worth individuals since its creation, and is fully sanctioned by the IRS. The practical limitation is that opportunity zone funds invest in real estate and operating businesses in designated geographic areas, so the investment itself must be evaluated on its own merits. But for an investor sitting on a large, long-term crypto gain who is going to diversify into real assets anyway, this structure can eliminate a tax bill that would otherwise represent a significant percentage of the gain. A related strategy involves charitable giving. If you donate appreciated crypto directly to a registered charity or donor-advised fund, you receive two tax benefits simultaneously. First, you never pay capital gains tax on the appreciated value of the crypto because you are not selling it. You are donating it. Second, you receive a charitable deduction equal to the full fair market value of the crypto at the time of donation. So if you bought an asset for $1,000 and it is now worth $10,000 and you donate it directly, you pay zero capital gains tax on the $9,000 gain, and you receive a $10,000 charitable deduction that reduces your taxable income. Compare this to the alternative: selling the crypto, paying capital gains tax on the $9,000 gain, and then donating the after-tax proceeds. You lose a meaningful percentage of the value to taxes before the charity ever sees it, and your deduction is based on a smaller number. Donor-advised funds are particularly useful here because they allow you to make the contribution and receive the full deduction in the current tax year, while actually distributing the charitable grants to specific organizations over multiple years at your own pace. For investors who plan to give philanthropically at any point in their lives, the question of which assets to give and in what form is a tax decision as much as a values decision. Appreciated crypto is one of the most tax-efficient assets you can donate. Let's now talk about a structural strategy that higher income earners and entrepreneurs increasingly use, holding crypto through business entities and taking advantage of the specific tax treatment that comes with business structures. If you operate a business, even a modest consulting practice, a content creation channel, a freelance operation, you may have access to retirement account structures that are dramatically more powerful than the individual Roth IRA. A solo 401k, sometimes called an individual 401k, is available to self-employed individuals with no full-time employees other than a spouse. The contribution limits for a solo 401k are dramatically higher than a Roth IRA, potentially over $60,000 per year, depending on income, combining both employee and employer contribution limits. Some solo 401k plans allow a Roth designation, meaning those contributions and all subsequent growth are tax-free. Others allow traditional pre-tax contributions that reduce your taxable income today. And a growing number of solo 401k custodians allow the account to hold crypto assets directly as part of a self-directed investment strategy. A SEP IRA, another retirement vehicle available to the self-employed, allows contributions of up to 25% of net self-employment income, up to a very high ceiling. While SEP IRAs are traditionally pre-tax rather than Roth, the tax deferral still creates substantial value, especially if you expect your tax rate to be lower in retirement than it is today. The core insight is this: earned income from a business is subject to self-employment tax and income tax, but money that goes into a retirement account before it's taxed reduces both your income tax and, in some structures, your self-employment tax. And if that sheltered money is then invested in an asset with crypto-level return potential and left to compound for years or decades, the cumulative tax savings are enormous. This is why tax planning and investment strategy cannot be separated. They are the same decision. The account you use is as important as the asset you choose. There is one more concept that belongs in any serious conversation about crypto taxation, and it is one of the most underused ideas in this entire space: the concept of strategic realization timing combined with income shifting within a family or household. Here is the principle. The 0% long-term capital gains bracket is a threshold defined by taxable income. If two people in the same household have meaningfully different income levels, it may be possible, through legal gifting of appreciated assets, for the higher income earner to transfer crypto to the lower income earner, who then realizes the gain in the 0% bracket. The IRS allows annual gifts of up to a defined amount per recipient without triggering gift tax. If the recipient is a family member with low or no income, an adult child in college, a spouse who does not work, a parent in retirement, and they hold the asset for the required period and sell it within their own 0% bracket, the gain may be taxed at zero. This is called income shifting, and it is entirely legal. It requires genuine transfer of ownership. It has limits and conditions that vary by relationship and jurisdiction, and it carries its own planning considerations around the recipient's overall tax situation. But for families where there are meaningful differences in income between members, this strategy can effectively move the tax burden of a crypto gain to a party who owes nothing on it. This is not a trick. It is the explicit structure of how the tax code handles gifts and how the capital gains brackets work at different income levels. It requires planning, documentation, and ideally the involvement of a tax professional who can confirm the specific parameters that apply to your situation. Let's step back and look at the complete picture. The reason most crypto investors overpay in taxes is not that the law requires it. It is that most investors treat taxation as a passive outcome rather than a variable they actively manage. Every strategy covered in this video, long-term holding to access the 0% bracket, sheltering crypto inside Roth,